In this session, I'm going to look at a better reference rate practices from the perspective of a central bank. Whatever the developments that happened in the recent days with respect to the risk management, we see that one of the important things is changes to the reference rates. The changes to the reference rates, and it is becoming very much important for the central banks to play an important role in allowing the parties to come up with alternatives to the existing reference rate. So alternative reference rates and transitioning from the typical traditional reference rate kind of an approach to an alternate reference rate approach. So the regular mechanism consisting of unsecured, the typical mechanism consisting of unsecured interbank term market. This is how a reference rate is coming up nowadays, whether it is LIBOR or whatever. Unsecured interbank term lending market is the typical mechanism that is currently there for the reference rate. It is observed that it is no longer applicable or no longer suitable for all market participants. If at all, at least for those where the credit risk is not existing to a large extent, probably the mechanism using this traditional reference rates is not adding any kind of a value addition. So that is where we will try to see what are the various mechanisms that are available, what are the various practices that are being looked at from the perspective of a central bank for arriving at better reference rate practices. So now, whenever this word reference rate comes up, it is used as a base for various financial instruments. It is used as a base for various financial instruments and for various money market based transactions, for various swaps kind of transactions. Reference rates are actually linking the payoffs of these various financial instruments to the money market kind of rates. So this is where the reference rates are playing a role, and they help in determining the payments for swaps or floating rate loans or any kind of interest rate specific derivatives. That is one of the major things. So probably you will see that they are linked, the reference rates become one of the important aspects for floating rate loans. They become very important with respect to interest rate swaps or interest rate options or any other derivatives based on the interest rates. So what we typically see when we talk about a reference, any reference rate is any basic reference rate. We see that it starts with a risk-free rate, and depending on the various risks that are involved with it, the corresponding risk premiums are added. So it could be maturity premium or liquidity premium or any of these, or credit risk premium or various other premiums can be added on to it to arrive at the reference rate for any kind of a security. So it could be associated with a maturity term, it could be associated with a liquidity, or there could be something associated even with a credit risk. So depending on the rate that we are deciding, we can depending on the mechanism we are talking of, the reference rate can be created using this kind of a process. And now what we have to see is the participants in the financial markets. If they are looking out for a common bank risk across an exposure to the bank, they look at probably the reference rate, which is based on the unsecured interbank lending rate, which is nothing but the LIBOR or some such kind of stuff, where the exposure is the entire common banks. But if some participants do not need an exposure to the common bank, then another reference rate should be talked of. LIBOR is not suitable for those kind of participants where they are not looking at the exposure to the common bank risk. So that is where another reference rate would form a better mechanism for those kind of transactions. Now, one what we could typically see is where when we are looking at various participants in the market, there are certain activities that have motivated the various market players to go ahead changing these kind of reference rates and get into the other alternative forms of reference rates. One, it is observed that there is a very low activity in these LIBOR kind of transactions, where the reference rate is interbank unsecured lending and borrowing rate is being used as a reference rate. There is a slightly lesser trading activity itself, and there is a lot of access to or lot of growth and heavy use of secured funding is available. So even that has motivated the need for changing the reference rates. And the derivatives market, what we see is derivatives market has become more and more sophisticated. Lot of reforms have come up wherein the funding is happening with almost no credit risk at all. So when the exposure to that of common bank risk is not required, why do I need to look at unsecured interbank rate as my reference rate? The derivatives market is able to create such a kind of avenues where the funding is happening with almost risk free, no credit risk present in it. So because of all these reasons, there is some level of motivation towards going towards the new reference rates. But at the same time, there are some kind of negatives or some kind of alternatives for various, some kind of blockages or hurdles in terms of switching towards the new reference rate, because various market participants not showing interest, though everyone wants to go for it. Various market participants are not showing interest to create the new rates, no interest to create new rates. That's becoming a one major hurdle for this. There are transaction costs are very high with this new rates, because unless the volumes come up, the transaction costs cannot come down, and coordination between the various market participants is going to be very difficult in this context. And the See, there are already so many existing contracts. There are so many existing contracts based on the current unsecured interbank interest rates. So again, uh, switching to a new rates for these kind of transactions can create so many user related obstacles. So that is one more dimension. There is a lot of friction or inertia that is coming up, because a lot of accounting related and risk management related issues will come up when switching from the existing base to a newer ones. And the accounting rules also needs to be modified, because the existing accounting rules, they give more and more preferential treatment to the specific reference rates. So these are some of the main reasons, though there is a lot of motivation to change the reference rates and move to the newer one, there is some kind of hindrances also coming for this move. Because see, one thing, if I have to look at the unsecured interbank market, the better way I look at is, lenders are getting, whosoever is the lender is getting a hedge against the funding costs. Lender is getting completely protected with a hedge on the funding costs, but the borrower, from a borrower's perspective, a lot of exposure to the interest rate risk is coming up. Interest rate fluctuations, the borrower is very much exposed to the same. See, what it could be right from a risk-free rate or any kind of premium changes because of the underlying economic factors changing. The borrower is getting very heavily exposed to these interest rate fluctuations. So there is a huge impact on the supply and demand of the credit, because from a lender's perspective, there is a lot of protection, which means the lenders are coming forward to lend more and more, whereas from the borrower side, there is a lot of risk involved, so the borrowers are coming in lesser quantities. So probably a mismatch between the demand and supply is straightforwardly coming out. And even from a monetary policy perspective, the reference rates are playing a role. From a monetary policy dimension, right? From a monetary policy dimension, we see that the reference rates are playing a key role, because especially when the economy is in doldrums or economy is in a stress period, we see that the reference rates behave completely in unpredictable manner. That is the time where the predictability has to improve. But what we see is, during the periods of market stress, the reference rates behave in an ad hoc and unpredictable kind of a manner. And the reference rates, the incorrect usages of these reference rates, and if they are resulting into the unpredictable changes without without proper analysis, whatever the reference rates are being used, they are resulting in a lot of unpredictable kind of changes. And apart from that, the major thing to look at is the cross border factors. Even they are impacting, especially something to do with the time zone differences and all. They are impacting the monetary policy transmission to a large extent. So even from that dimension, the reference rates need to be looked at. And we know the more robust a reference rate is, it could, the more robust means it is adding to the financial stability. So the reverse of it is, the less robust, we see that it impacts the financial stability. It creates a problem to the financial stability also. And what all could it result in? If the reference rate is not solid, the confidence level in the investors or the various market participants will actually go down. That is affecting the financial markets and the financial stability of that economy. And the way the risk transfer occurs, the way risk transfer occurs to the borrowers will create the serious problem. And the various securities that are using that reference rates, they go mispriced, and lot of arbitrage opportunities will start developing because of that. And the reference rates would be mismatched for various maturities, and that would typically create huge basis risk, and people can take advantage of that risk and start their trading activities. And that would impact the central bank or the reserve bank's ability to respond to financial instabilities, whatever the instabilities that have come in the financial sector. They cannot react or respond to them in a timely manner because of wrongly measured reference rates. So from all these dimensions, yes, coming up with the new reference rates is always a welcome task, but at the same time, computing the reference rates in a wrong way or using the wrong reference rates will impact the financial stability also very badly. So whenever I talk about the effective interest rates, whenever I talk about the effective interest rates, we see that it has to have a few characteristics. The interest rate should be reliable. What do I mean by this? There should not be any kind of manipulations, right? It should be free from manipulations, or it should be free from any kind of errors. So there should be a lot of reliability built into the interest rates. There should be a lot of robustness built into the interest rates. So even during some kind of stress periods, they should be usable. Any kind of extreme scenarios, they should be usable in the same way as they are used in a regular scenario. The frequency, they should be able to be calculated at on a regular basis, right? It should not be a very difficult process to compute those effective rates. The availability is a very key factor for them, means a regular publishing of these interest rates should happen at regular intervals of time, at regular avenues. And they should be representation of the contracts. They should act as a representativeness to the contracts. Relevance of the interest rates to the various contracts should be present. Only when any particular interest rate satisfies all these characteristics, it becomes more and more effective also. So now when we look at the various alternatives that are available to the traditional reference rate, which is generally based on LIBOR. If the alternatives are there, okay, some of the things, as I said, there are a lot of motivations to go towards the alternatives, especially if the credit risk associated with the whole banking system should not be taken, then an alternative reference rate has to be looked at. But as we have seen earlier, the trading activity is not so high. So the activity, unless the activity improves, the transaction costs and all cannot come down. So the trading activity is much lesser, and because the activity is much lesser, the liquidity is also not that high. Means liquidity risk is much higher. The liquidity is lesser, and funding costs are getting more and more because of the above factors again. So it is expected that the private sector should come forward and it should develop, design some kind of mechanisms, some procedures to come out with the new alternatives to the reference rate and even publish them. And anything related to the subjectivity that is involved with the new rates that are published, that needs to be improved using expert judgment. One more important characteristic that is expected, because whatever the rate setting mechanism, whatever the reference rate calculating mechanism that is being arrived at, any kind of subjectivity that is present in it, that needs to be addressed. And the experts advice and experts judgment need to be considered while arriving at that kind of a process. But when we are looking at the role of the public sector in the same, especially the central banks, which form a part of the public sector, from their perspective, there should be more and more of encouragement to the private sector, and it should remove all kinds of obstacles associated with the current reference rate, and it should motivate the private sector to come out with various procedures to arrive at alternative reference rates, and it has to encourage the most optimal use of the alternatives, and it has to remove all kinds of obstacles that are present. Means it has to work with the regulators, it has to work with the regulators and the other, and probably the private participants, to strengthen the governance part of the reference rates, the rate submission process should be fully monitored, transparency in the rates submission and processing and evaluation should come out, and a guidance regarding the same need to be developed on how to use these various reference rates that are published from various entities. So generally, from the policy standpoint, we see the various tools that the central bank typically uses from the change management perspective. There could be simple verbal comments, may or may not be effective, but the more important part of it is promote transparency. Transparency where liquidity, improving the liquidity, tenure of the transactions, availability of availability of trade volume and price transactions, all this data has to be made available to a large extent. Collection and dissemination of trade data, processes have to be improved. All these things, and even knowledge sharing, technology sharing, this entire thing has to be improved. This entire process to be improved. All these things should be coming out from the central government perspective as a policy tool for improvement and for some probably creating new markets, providing whatever the support, because there is a lot of illiquidity associated, providing the support for creating the new market, at least for short term risk free rates, by coming out with the calculation of overnight rates, by coming for the new reference rates that are identified, coming out with the calculation of the overnight rates and standardizing the coverage part of it. Even that could be one more area that can be looked at. And transition, playing a role in transitioning of the reference rates, transition from the old reference rate, transition to new rates can very well be supported by various consultation and collaboration activities with respect with the private sector, publishing legal opinions on the transition process, if required, coordinate with the accounting standards, change the laws. All these things can very well be attempted to come out with new alternatives to the risk free rate. So this is a very interesting article with respect to moving towards the new perspectives, moving towards the new perspectives and coming out with better reference rate practices, which will become more and more effective in the time to come. If you have any further queries on the same, you can get back to me by giving me a call on the number that I have given below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.